studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
One of the most important shifts in owner-manager tax planning happens when both spouses become actively involved in the business. Up until now, we've been looking at situations where compensation is paid primarily to one individual. In those cases, most or all of the income eventually flows onto a single tax return. As shown on the left side of the slide, the traditional approach is relatively straightforward. The corporation earns income, the owner receives compensation, and everything ultimately flows through one taxpayer. While this may be simple, it also means that all of the income is concentrated on a single tax return. As income increases, more of that income may be exposed to higher tax brackets, and the family has fewer planning opportunities available. Now let's look at the right side of the slide. When both spouses are actively involved in the company and contribute meaningful value to the business, the planning landscape changes significantly. Instead of having one active participant and one taxpayer, we now have two active participants and potentially two taxpayers. The corporation can potentially compensate both spouses, resulting in two separate tax returns rather than one. This is the key breakthrough introduced in this scenario. Professional family tax planning does not focus only on the business owner. It looks at the entire family unit. Once there are two active individuals involved in the company, planners can begin evaluating compensation strategies that take both spouses into account. This doesn't automatically mean taxes will be lower. It doesn't mean compensation should always be split equally. And it certainly doesn't mean income can be shifted without proper support. What it does mean is that the planner now has additional options to analyze. Instead of evaluating one tax return, the advisor evaluates two. Instead of looking at one taxpayer's tax brackets, the advisor examines the family's overall tax picture. Instead of focusing on one compensation stream, the advisor can explore how compensation might be allocated between two active participants. This is why the message at the bottom of the slide is so important. Two tax returns often create more planning opportunities than one. The goal is not simply to divide income. The goal is to analyze whether involving both spouses in the planning process can produce a better overall outcome for the family. As we move through this scenario, we'll explore several ways compensation can be shared between spouses, including salary strategies, dividend strategies, and hybrid approaches. The important takeaway from this slide is that family tax planning starts with the family itself. Once both spouses are legitimately involved in the business, the conversation shifts from one taxpayer to two taxpayers. And that opens the door to an entirely new set of planning possibilities. Now that we've established that both spouses are actively involved in the business, the next step is determining how compensation might be shared between them. One of the most important lessons in tax planning is that there is rarely a single perfect solution. Different families have different goals, different cash flow needs, and different long-term priorities. That's why professional advisors often compare multiple compensation structures before making a recommendation. The first approach shown on this slide is equal dividends. In this example, each spouse receives $75,000 in dividends. This approach is often attractive because it is simple and straightforward. Both spouses receive the same amount, and there are no CPP contributions because dividends are not considered employment income. For some families, this simplicity can be appealing. However, because dividends do not generate RRSP contribution room and do not contribute towards CPP pension benefits, there may be trade-offs that need to be considered. The second approach is equal salaries. Under this structure, each spouse receives $75,000 of salary. This creates CPP participation for both spouses and generates RRSP contribution room for both individuals. It also creates employment income, which can be useful for mortgage qualification and other lending situations. The trade-off is that CPP contributions apply, and the overall tax outcome may differ from a dividend-based approach. The third option is the hybrid strategy. In this example, each spouse receives $50,000 of salary and $25,000 of dividends. This creates a blend of employment income and dividend income. The salary portion helps generate CPP participation and RRSP room, while the dividend portion provides flexibility and may improve the overall compensation structure depending on the family's objectives. This is why many advisors like to include a hybrid option whenever they perform compensation planning. It allows them to capture benefits from both systems rather than relying entirely on one approach. Notice the message at the bottom of the slide. There is no universal best option. The best strategy depends on client goals. That statement is incredibly important because many people approach tax planning looking for a single answer that works for everyone. In reality, tax planning is highly personalized. A family focused on retirement planning may prefer one approach. A family focused on maximizing current cash flow may prefer another. A family preparing for a mortgage application may choose something different again. The role of the advisor is not to assume which option is best. The role of the advisor is to analyze each scenario, compare the results, and explain the trade-offs. Only after understanding those trade-offs can the family decide which compensation structure aligns best with their objectives. As we move to the next slide, we'll examine why splitting compensation between two active spouses can often produce better tax outcomes than concentrating all of the income on a single tax return. This slide illustrates one of the most powerful concepts in family tax planning: the potential benefit of spreading income across two taxpayers instead of concentrating everything on one tax return. Let's start with the situation shown on the left side of the slide. In this example, one person receives all of the compensation from the corporation. The entire $150,000 flows onto a single tax return. As income increases, more of that income moves into higher tax brackets. This creates a concentration effect. The more income that accumulates on one return, the more likely it is that portions of that income will be taxed at higher marginal tax rates. Now let's compare that to the right side of the slide. Instead of paying the entire amount to one individual, the compensation is shared between two active spouses. In this example, each spouse receives $75,000. The total family income has not changed. The corporation has not earned more money. The family has not created additional income. The difference is simply how that income is distributed across the family's tax returns. By spreading income between two taxpayers, more of the family's income may remain in lower tax brackets. This can potentially produce a better overall tax outcome than concentrating everything on one person's return. The staircase illustration in the center helps visualize this concept. When one taxpayer receives all of the income, they climb further into the higher tax brackets. When income is spread between two taxpayers, each individual may remain lower on the tax ladder. This concept is one of the foundations of family tax planning. However, it's important to remember that tax savings are only one part of the analysis. Notice the planning benefits shown across the bottom of the slide. When two family members are actively involved in the business, the family may also gain additional opportunities related to retirement planning, CPP participation, and broader financial planning objectives. Each spouse may be able to build their own CPP entitlement. Each spouse may have their own retirement planning strategy, and both spouses may become active participants in the family's long-term financial plan. This is why professional advisors rarely look at one tax return in isolation. Instead, they evaluate both returns together. The advisor shown in the bottom corner captures this mindset perfectly when saying, "Let's analyze both returns together." That is exactly what professional family tax planning requires. The objective is not simply to minimize tax on one person. The objective is to optimize outcomes for the entire family. And that brings us to the key message at the bottom of the slide. Family tax planning starts by looking at the entire family, not just one person. Once both spouses are actively involved in the company, the planning conversation expands from an individual tax return to a family tax strategy. And that often creates opportunities that simply do not exist when only one taxpayer is considered.